credit card, ACH, Wire, Zelle, Venmo, Cash App. Essentially, all transactions fall into one of two categories, pull or push. In this video, I'll explain the simple method of classifying transactions, which will help you understand payments better. A fundamental principle of classifying a transaction as a pull or push, very simple. In any given transaction, we have a buyer and we have a seller, or a payer and a payee. In a typical payment transaction, the funds flow from the buyer's account to the seller's account. When the buyer provides credentials of his or her account from which the money will be transferred to the seller's account, and then the seller initiates the transfer from the buyer's account, we call this a pull transaction. Unlike in a pull transaction, in a push transaction, the seller provides his or her account credentials to the buyer, and then the buyer initiates the pushing of the funds to the seller's account. So the difference between push and pull transaction, as you can see, may seem very insignificant, but that difference has very, very significant implications about which we'll learn later. This is the list of most popular payment methods in the US. As you can see, most payment methods fall under the push category, and there is a reason for that. For pull transactions to work, both the payment origin bank and receiving bank need to use the same protocol or to be on the same network of some sort. Getting the banks to integrate into a new network is a very challenging endeavor. Probably the most notorious example of a pull transaction is the credit card transaction. So let's go back to our previous presentation. The buyer provides the credit card information to the seller, and then the seller subsequently uses that information to pull money from the buyer's account. To do that, the seller's payment processor, be it a Stripe or PayPal or any other, uses a credit card network. To learn how these credit card networks work, subscribe to this channel so you don't miss the future videos that will cover this topic. If you used Zelle in the past, you've experienced the push transaction in action. With Zelle, the seller provides the phone number or an email address associated with their Zelle account to the buyer. And then the buyer initiates the transfer of the funds using bank's website or a mobile app. The most significant advantage of a pull transaction is the control that it provides to the seller. This is why credit card payments are the most popular with e-commerce transactions. Merchants have control over the amount that they can pull from the buyer's account. In addition, merchants receive instant confirmation of the payment status. This fact greatly simplifies order processing. Once the payment is confirmed, the order can immediately be dispatched for further processing. The prospect of being able to pull money from someone's account is very attractive for actors that are engaged in all sorts of fraudulent activities. Since all you need is an account information to pull money, it doesn't require much effort to carry out the fraud. Fortunately, year after year, payment processors, along with card issuers, are getting better at detecting fraud and eliminating it. That comes with the cost of card transactions becoming more and more complex. Another disadvantage of pull transactions worth mentioning is that usually pull transactions fall under stricter regulation rules. Your business will likely be rejected if a payment processor determines that your business falls under the high risk category. Unlike in a pull transaction, in push transaction, the payer is in full control. The payer determines when and how to make transfer to the seller. Needless to say, that is very beneficial to the payer, but creates many challenges to the seller. Nothing prevents the buyer or payer that intends to pay for goods or services to put a wrong amount, for example. That creates even more challenges in how to handle these types of cases, especially if additional transactions result in additional fees. Sellers would have to inform a buyer about how these types of cases are handled and who is responsible for incurred expenses. In e-commerce, this introduces a delay and additional friction for sales. A buyer is required to access his or her account and put in the correct destination account information as well as the correct amount. Very often, the interface for these actions varies drastically from one platform or bank to another. For non-tech savvy users, this poses a great challenge. Luckily, technology doesn't stand still and constantly evolves. More banks and platforms make push transactions simpler by pre-filling the required information and leaving only the confirmation step for the users to complete. There isn't the best payment type. All payment types have their advantages and trade-offs. The choice of the right payment type for your business should be dictated by your business needs. Many payment processors today offer a variety of payment types they can process and you can choose from. To learn more about each of those payment processors and payment methods individually, don't forget to subscribe to this channel. See you later.